What's up, everybody? We're back with another edition of the Sunday Scaries Stock Talk podcast. I'm here with Sam Stribling at Strib on Common Stock, if you guys are on there. And then also Sam_Stribling3 on Twitter. Sam, how are we doing today?
Doing pretty good, my friend. So thank you very much for having me. I'm excited to be on here.
Yeah, welcome,
Looking
welcome.
forward to it.
All right, for those who don't know anything about you or anything like that, why don't you introduce yourself and give yourself a little background on your investing journey and everything like that.
Sure. So to start off, I'm a retail investor, kind of like most out there. Been doing it for about 10 years now. So at least I've kind of stood the course for a little bit. I work in technology as a small business owner, actually, myself. And so I work specifically with hospitals' risk managements and their information systems, more or less. So actually, it's salesforce.com is the platform that basically allows me to do what I do. So I spend quite a bit of time there. And just looking forward to following the market. Like I said, I've been doing it for about 10 years, kind of help some of my friends and family out. That's kind of how I found Common Stock, as well as just another good place to really learn more about the market, stay engaged, and try and keep pace.
Yeah, awesome. Yeah, so for those who don't know, Common Stock is more or less a platform. I would kind of categorize it as just strictly like FinTwit. You could put a little bit more, longer memos and things like that. So it's not necessarily broken down to the 250 character Twitter limit, and
Mhm.
it's really informative. So if you're on there, you should go ahead and check it out. And then I'm also at Green Candle IT on there as well. So I got some stuff out there, and yeah, they've been putting together a lot of great stuff. But let's get into it. So you said you've been an investor for 10 or so years. I think right now is a very, very interesting time with the extreme inflation that we're seeing. I
Yeah.
think a lot of my audience is pretty similar in age to us, maybe not necessarily to the experience level of you or I in investing.
Mhm.
Um, so why don't you go into, I guess, a little bit about how you feel, investing in a time like this, and kind of, I guess, more or less your strategy going into, when you're
Sure.
seeing CPI prints at, as high as we're
So,
seeing right now.
yeah. So, well, you kind of, for me, I like to stick to the strategy. So even if it's not the best of times. So the past year, full disclosure, has been tough. I like growth. I like tech. I feel like that from a young person's perspective is a good place to be, but I'm sticking with it. Right. And so what I'm doing is I'm really practicing a dollar cost average model. So trying to buy into the weakness and or into how things are going and if they're going up, and looking to just kind of build substantial positions over a long period of time. I split it up over 3 different accounts. So, or 4 actually now. So 3 are tax sheltered. So, got a traditional IRA, a Roth, and another IRA that I converted over that I need to kind of consolidate. Um, Plus, I've got a taxable account as well. So that's kind of how I like to do that. So I can kind of minimize the taxes as much as possible. Obviously, I'm playing the long game in those retirement accounts, but for the most part, even in the taxable account, my average hold is a year plus. So I am not a big fan of the jumping in and out. I'll dabble with the technicals and things like that just to kind of watch the entry and exit points so that I have a better understanding, and I really do enjoy them. But I think slow and steady wins the race, and buying high quality names and sticking to it. So inflation's terrible. Yep. Costs are going up, stocks are going down. We've got rates raising and a few other things kind of as headwinds that we've got. But as I've kind of been in it for, like I said, about a decade now, you kind of have to roll with the good times and the bad times. And honestly, if you can kind of see beyond the 6, 7 months that, most people's scope really goes out to, because I'd be surprised, honestly, if anybody can go much further than that, truthfully, just because you don't know what's going to happen. You don't know about the war in Ukraine at the time. You don't know about, COVIDs and all the other things that are the black swan events that seem to kind of continuously happen. But stay with it, keep going. And if you're in growth stocks, take this as an opportunity to add into them. If you do feel like you need to make kind of a shift or a pivot, I would make sure that every stock that you're in, you have a reason to be there. And as long as that reason is sound, stick with it. Right. So it's going to be different for everybody, but that's the way I like to approach things.
I gotcha. Okay, so I guess let's just back it out to your overall strategy now. So you said
Mhm.
you're more of a growth investor. You like a lot of the growth stocks. So when you're looking at a growth company, how do you really break it down, and how do you determine names that you're like, okay, this is one that I see that I'd like to invest in?
Yeah, so I like to keep it simple and buy what I know, right? So if anybody goes and takes a look at my portfolio, they're going to see a lot of household names, right? So I've already mentioned that I work in Salesforce, so that's like one of my core positions. Um, just kind of building systems in on their platform. I have the opportunity to see the updates and rollouts in real time and things like that. And frankly, the fact that I couldn't operate as a sole proprietor without them, and I have clients that are, large hospitals and things like that is pretty amazing. The startup costs and things like that have changed dramatically over time. So that's obviously a name I want to be in because of that. Another one, Apple, another staple. I've got an iPhone, Apple TVs, kind of all that type of stuff too, right? So being a user or knowing that product in and out is something that I really like to use for the most part as my reasons to buy. And so again, you'd see that with um, Roku and some of my other names too. Now I will branch out of that because obviously, like I've got Tellurant on there, and a couple other companies like that. That's a natural gas play, and those are for more diversifications and purposes and things like that, just to have a little bit of exposure to energy, which has been kind of a saving grace for me this past year. But it's kind of in that strategy. So again, just kind of having a reason to be there. But for the most part, I'm buying what I know. Household names, strong fundamentals, things like that have again kind of a reason to buy. Like if I got to really like the product to own the company, because that's the way I look at it. Right? Is if you're a shareholder, you're a part owner of the company, and that's really what I'm looking for. So kind of buying those quality names and things like that. And then frankly, I'm kind of always trying to learn and look at different people's portfolios, what they've got, try out different products, and make my own decisions about what's best for me.
Yeah, so I think it's pretty interesting the way you describe that, because I think Warren Buffett has famously said, invest in what you use, and invest in companies exactly like you're saying. But
Mm-hmm.
the way you look at it is more so growth, and it's more like tech stocks, right? Because the younger generation like us, we use a lot more technology than maybe
Yeah,
say
that'd be a big
Warren
part.
Buffett.
But I'd say it's almost barbell like, right? Where you kind of have your high growth on one side and then your value as well. Because I will try and kind of balance that out a little bit. And so, kind of to Warren Buffett's thing, like I have McDonald's, right, in my portfolio and think it's a great product, think it's a great company, and that's why I own it. But I wouldn't exactly chop that one up to be, a hyper growth name per se, right? So kind of everything with balance and again, kind of having that reason. But at the same time, in times like this, McDonald's for me has been, a solid stock to kind of buoy the portfolio, if you will. So I don't know. I see a lot of folks that kind of go all in one direction and they diversify, if you will, but it's all within the same sector, right? Um, Specifically, tech is typically the one that you see the most of, right? So they'll be like, oh, I've got Apple, I've got Google, I've got Facebook, you're like, all right, so you've got Fang, the big names and everything, but um, that's so I like to try and kind of balance that out a little bit. So I will branch out beyond the things I know to well, honestly, I'd still say that I know things like McDonald's. I've had too many cheeseburgers in my day anyway, but you know.
What
um,
American hasn't, right? So.
right, exactly.
Yeah, so I mean, I guess that's interesting. That's a good point. So I mean, there's a couple different views there, right? So you're bringing up more so diversification. So
Mhm.
I'd like to kind of get, I guess, more in depth of your viewpoint of there, because right now we have probably more so volatile times than in the average stock market, right? So we had
Oh yeah. I mean,
the
some of the most
S&P
volatility I've seen in the 10 years I've been doing this.
Yeah, so what the S&P 500 was up about like 23%, I think, by the end of last year.
Mhm.
And so, we're having 23%. The average is like 10 to 11 since I can't even, I think since the 40s or so. So, obviously more than double of that growth.
Right.
Um, that we see on average. And yeah, so because of this volatility, you're kind of bringing up diversification.
Mhm.
But a lot of young investors, and I hear this idea get thrown around a lot, where they say, you know, focus on one, one single area and go kind of all in there to create wealth, and that diversify to
And then
maintain
figure
wealth.
it out later? Yeah.
Yeah. Do
I've
you
tried
kind of
that before.
do you
Um,
ascribe to that theory, or do you kind of more so think, because of the times that we're in and so diversified, that it's maybe you'll lose out on some returns, but you won't get quite the losses that you'll get right now if you diversify?
right. So, and there's a couple points on diversification too. Like people will often point at the averages, for example, as elements of being diversified, and I actually disagree with that personally. And the reason that I do is, when it comes to the Dow and the S&P, and actually I wrote a piece on common stock on this, going into the math of it, but they're weighted averages for the most part, or to kind of boil it down. And so it's 5 or 6 stocks that really control how that average is going to do, right? So if you were to look at like the median price increase or decrease, most companies, like 70% or something like that, are sitting on 52-week lows, but the averages aren't. And the reason that the averages aren't is because if you keep Microsoft, Google, these multi-trillion-dollar companies up there, it takes a whole lot of small caps to make up an Apple, right? Um, I think it's something like 496 of the S&P 500, which is actually 506 stocks, not 500, which is something I found out that was odd. Um, is is all tied up in that one area, right? So you got 50% in 4 stocks. So that's really what's buoying those averages. So it might not necessarily be the real diversified thought that you had originally, if you will. So what I like to try and kind of do is break it down into sectors. So, predominantly tech, I'm young, so I'll do maybe 50% of my portfolio into that, maybe 10, 15%. And I like to kind of keep it smaller too. I can't keep track of, some people have these giant lists and it's all less than 1% is their weights, right? And they have 1,000 stocks. You might as well buy an ETF, in my opinion, at that point, because you can probably get a better sector ETF for that, and get that diversification at that level. I like to kind of try and pick the best of breed within each of those sectors. So like for financials, my play is Bank of America. Consumer discretionaries are things like Apple, which would kind of fall under that tech umbrella too. Roku's, again, kind of half and half, but I would put McDonald's as consumer discretionary as well. Then some energy plays, things like that. I actually got kind of lucky on one. I've owned Allegheny Corporation for the past like 5 years, and Warren Buffett bought that out last week. So that was pretty fun. So I got a 25% pop right off of that. And that's honestly, I bought Allegheny because it was a small Berkshire Hathaway. Like they do the same thing. It's just another insurance company that's a holding company that buys small private organizations and kind of rolls them up. And so as opposed to going, deep into Berk B or I wish Berk A, but at $500,000 a share, I'm not quite there. But I kind of, like I said, sometimes staying in it and buying those names that other people don't really know much about, but their fundamentals are solid, pay a good dividend and things like that. Times like this, it kind of works out great. And that's kind of the way I view diversification. So I like to be kind of solid and have my positions be roughly 5 to 10% each, and keep it under 20, if you will, so that I can kind of get that diversification. But I think some people spread it just way too thin, where they've got less than 1% in each of these. So let's say you have a rocket ship and you caught one, it doesn't really matter, right? Because it's not going to be, unless you got Bitcoin at 2012, right? And it has the ability, or Monster Energy in 2009, in 2009 or something like that, you're talking about 70,000% returns. That's not something I can bank on, frankly, right? I would chop that up into the luck category. So that's kind of the way I perceive diversification and things.
Okay, I gotcha. All right, well now let's get into like a little bit of the macro, right? So we've had kind of a crazy couple 2 years or plus, I would say.
Yeah,
So
1 3, right?
Yeah, so we've had, the COVID pandemic led by
Hmm.
massive amounts of money printing by the Federal Reserve.
Yep.
And then now we're having this, Ukraine, Russia war going on.
Hmm.
But actually today, I think they even announced it. Today's Monday, the 28th, when we're recording this. They announced that Russia might be backing off slightly. But that's, time will tell if that actually happens or anything like
Yeah.
that. So, how do you view something when it's kind of like, I guess, this black swan event with COVID, and then,
Hmm.
then I guess we'll get into the Ukraine Russia war. Like, how do you approach these kind of things? Do you try to sell out like a little bit when it starts to dip just slightly, and then buy back in at the bottom, or do you just I know you alluded to the dollar cost averaging a little bit earlier, but how
I
did you
lied.
do this?
So honestly, I didn't sell anything in COVID, and I remember just kind of questioning myself. I think it was like March 20th of 2020, right? I think that was the bottom, if I'm not
Mhm.
mistaken, or somewhere right around there. Trust me, it was when Bill Ackman and everybody was freaking out. Um, I mean, you're taking a big haircut, is what you're doing, right? But at the same time, we rocketed back that second half of the year, mainly off the back of all the stimulus money and things like that. But I am so glad that I did not sell into that weakness. That's one of my main things is um, I won't sell something unless I really need the money for something. So like if my wife and I want to do a renovation or something like that, I might dip my hand in the cookie jar or something like that a little bit, right? But that's also why kind of what I mentioned earlier is splitting it up into multiple accounts. So 3 of the 4 are retirement. And so I can really only grab from a quarter of it anyway, right? Um, and so that's kind of how I almost protect myself from it. And then all the dollars that I get coming in, even though it doesn't sound like much, but every 2 weeks I put $250 in each account kind of thing, and let those keep going, set all of my dividend payers up to be drips or dividend reinvestments, so that you can kind of get the power of that compounding and things like that too. So I didn't sell at all through it, and I have no intention of selling through, kind of the current state of the market, even if that means it's going to be a tough couple of years. I would say even though we rocketed back, COVID was a tough couple of years too, right? It wasn't easy to trade in that environment. And so that's why, again, I kind of like to stick with it. But the way I look at it is like the companies that I'm buying and things like that, like, is McDonald's going out of business? I don't think so. Bank of America, no. A couple of the ones that I've got that are small caps, hopefully not, because they've been beaten up pretty bad. Like I have Fubo TV, for example, which is one that I really like as a product. I actually use it over YouTube TV and all the other ones. But if you go look at the chart, it's kind of been going in the wrong direction for a little while here. But I've been adding to it, and the way I see it is granted we have a Chapter 11 situation, which I don't believe we will at the growth rates that they've got, and I think that the leadership is strong in David Gandler. I'm holding it. And I'll just keep adding, even when it hurts, I guess is the way to think about it.
Yeah, so it seems like basically you're essentially saying if your thesis doesn't change on a company, and you correct me if I'm wrong, if your thesis doesn't
Oh, you're
change,
right.
you're not
Mm-hmm.
going to sell even in these hard times.
Yeah.
So, I guess let's bring it now to more common or more recent conflicts.
Mm-hmm.
So the Russia-Ukraine war going on here. So how are you viewing it? Are you like kind of diving into different sectors because of this conflict? I know you kind of mentioned a little bit like some oil and gas plays.
Yeah.
I know that oil and gas has been doing pretty well ever since we had a change of president in the United States, at least
Mm-hmm.
because of policies and everything like that. So, how are those doing now? And I guess how are you looking at more of those oil and gas stocks right now? And
Sure.
yeah,
So obviously, basically, it's a supply and demand problem, right? And you'll hear out of the talking heads and things like that. It's a global market, all these types of things, but which it is, but it's not as straightforward as that in my experience, right? So like you can go up and down on an individual country's production, whether it be the United States, but if other areas are being cut out, like Russia, for example, which is kind of what's happening now, which has kind of caused this big supply shock. Um, Plus, you're not really able to turn on a dime in those businesses either. So, to answer your question, My play Tellurant has been doing fantastic. It's the best performer I've got this year for sure. But at the same time, I've been in that for a long time as well and continued to buy and buy and buy. To kind of give you an example of the extreme levels I'll go in holding on to the stock, I in that March of 2020, Tellurant got cut by 90% in a single day. So it went from $8 a share to 88 cents. So I actually dragged my cost basis down to 98 cents a share that day. So I guess I times 1,000. I don't even know. Like, I was buying it at $10 a share. So I was like, well, if it's under $1, I guess it's got to be a better deal. And now with it sitting at $5.75 a share, it's about a 500% return. So, and again, I sold 8% of that last week because I try not to get greedy about it either. And so I was like, well, let me take a little bit off the top, just kind of considering the run that we've been on. But, still holding on to 90% plus of that. So basically I turned kind of a big loss where most people would cut their losses and just leave. But I was like, my thesis on natural gas was, if we're going to go to these green energy areas, you can't just turn the switches off, and you're going to have to bridge that gap somehow. And so I viewed natural gas as the natural bridge for that, which is why I bought into it. And then I didn't think any of that had changed just because of COVID. So I was like, oh, I guess, for an extra couple $1,000, I can, buy thousands of shares of this. And so that's what I did. So, I massively increased that position, and this year it's really paid off, on paper anyway, because again, I'm not selling it really, but took some of those proceeds. I'll probably sell another 5% or so. And then because at that point, everything I'll have will be house money, and I'll be able to reinvest some of that initial capital into, I don't know, something else, maybe buy some banks or something like that, just because with rates rising, I think those might be a good place to put money.
Yeah, so I guess you got deep into the oil stocks there. So do you think any other specific sector is going to be drastically affected by the
I
Ukraine
do.
conflict?
The one that I'm looking at, and this is kind of, I'm at the beginning of my prospecting, I guess, on this, is basically a ton of wheat comes out of the Ukraine and Russia. And so I'm actually looking at companies like General Mills and maybe some Procter and Gamble and a couple of other ones like that, because one, I feel like that's it's not a product that you don't buy, right? Everybody's going to buy the bread, no matter what it costs, is what I'm thinking. So what I don't know yet is, and what people forget when it comes to agriculture things, is we're eating last year's grain. So the harvests are not coming this fall, is what's going to happen with the grain, not the other way around. So what we're eating off of is our reserves. That's why we haven't really felt it yet, and there's a big lag. And I think that those are oftentimes really good opportunities in the market, because basically, if you're kind of your typical trader, you don't think about that type of stuff, right? Like, the bread at the supermarket is this. Yeah, sure, it might be going up, but I don't see it going out of control, and it might be a little too late at that point. But kind of as I've been looking into it, because that's their number one export, obviously they're not going to be planning right now because it's springtime. This is when they would be doing that. In Russia, with all their assets and everything like that tied up too, I just can't imagine that even if they do produce it with sanctions and things like that, we've got who's going to buy it, right? So I kind of see those coming out. So I'm trying to think of basically like General Mills would be another name too. People that make cereal, beer, Constellation Brands, because basically wheat goes into tons of beers, and that's who owns most of them. So those are kind of things that I'm thinking about as potentially kind of recovery plays, if you will, on that. And I'm thinking about them now because, well, it just hit the news cycle last week when basically some of these guys, Biden's, the UN, and all them were kind of talking about potentially having serious food shortages and things like that. And again, I don't think that people kind of put two and two together with how drastic that lag is. So since we're such a big bread basket here in America, as those prices rise, I have a feeling we're going to be exporting that just like we're exporting natural gas and things like that on kind of a higher clip, which will probably raise those prices even more.
Yeah, I mean, it seems like now, like because of this conflict and the sanctions we're putting in place on Russia, you kind of alluded to it before, but it seems like before it was more so, a global economy, and now we're kind of seeing, I guess, the potential issues of that, and
Yeah.
it seems like each country is kind of deciding to become more I guess, self sovereign, self independent.
Self-sufficient is really what
Yes.
it is, because if you have these, well, the globalist idea only works if everybody's friends, really, is what's going on. And what is concerning, I think, to a lot of people, right, left, or wherever you fall on the spectrum, really, is just that we can't depend on others for these types of things, right? So energy independence would be great. Obviously, grain independence, I guess, is what we would call it with the other one there. But being able to make sure that you have what you need in some form or fashion. And then you've got all these other countries too, like, France is looking really smart right now with the way they went into nuclear compared to Germany, who went all into natural gas, thinking that natural gas wasn't going to go anywhere. And, they each had their pros and cons, right? The con at the time a year ago was, well, we don't want to have nuclear waste and all that type of stuff. And well, now they don't have a reliable source of Russian gas to get, which is driving their costs up. And the French have 70% of their energy in nuclear. And so that's really kind of turning into a boon for them from an energy perspective, because it kind of eases those tensions. Plus, energy is on a grid, right? Especially electricity. And so you saw like the Russians, what they're doing to make us a little more dependent on that gas is as they go through town, if you will, they shut down the nuclear reactors that they cross. And that, if you want to heat your house, if you want to do all that, it just puts additional strain on that grid, which doesn't really care about the border, right? It's just pulling from one place or another. And having some of those large nuclear reactors over in Ukraine that are not running right now is really straining other countries to make up that deficit. So I think you're right. It's kind of, the pendulum's turned from globalism, I guess, to nationalism, I guess would be the opposite of that. And I don't think it's necessarily a bad thing either, because as we're seeing with a lot of these treaties and things like that, tying people up, they're only as good as if you're willing to stand on it. Right. And like, look at us, and I hate to say it, but nobody's really coming to the Ukraine's rescue. Right. And I get why we don't want a world war and all that. Totally get it. But if you're Ukraine, right, you're kind of looking around like, what do you mean you're not going to help us out? Right. And so we'll see. I'm not sure to what the future holds for like a NATO, for example, because I mean, they were originally designed to kind of stave off the Russians in the Cold War. Cold War ended 30 years ago. And I guess because it's still there, it's almost putting us back into it. It's like hammers and nails in a way. So it's kind of interesting to see that play out as well.
Yeah, for sure. I mean, it's definitely a lot going on geopolitically. As it's exactly like you said. Nobody seems to be coming to the Ukraine's help. I'm a Bitcoin guy specifically, so I've seen a lot of Bitcoiners and people, individuals, kind of donating to the Ukraine and things like that, which has been awesome to see. But yeah, as far as countries and everything goes, it hasn't really been the case. There's kind of another looming conflict. We talked about it a little bit on the pre-show. China and Taiwan, there's been kind of rumblings that China might decide to do what Russia's doing to the Ukraine right now and enter Taiwan. How are you viewing that situation? And are you kind of being wary of certain sectors because of, I guess, that looming situation?
Yeah. So, I mean, the one that sticks out the most is the semiconductor area, right? And just because you've got Taiwan Semiconductor, who's one of the like largest foundries and does all types of different work in and around the space. It's a pretty complicated area, right? You've got like the NVIDIAs of the world that are more designers, and then they have kind of other people that produce it. But I think it's something like half of the world's chips really come out of Taiwan and that area. And, you know, from the Chinese perspective, it's never been its own country. That's the part that people kind of don't understand on the West, right? Is that's just part of China, the one China policy and things like that. And China also plays a long game that we really don't over here in the West. I mean, they look at things in seemingly decades and centuries and things like that when it comes to what they're going to do and the moves that they're going to make. But like we're seeing last year, I think it was, Hong Kong kind of started having some protests and unrest and things like that. But that was 20 years after, I think it was like the 1997 conference, if you will, that basically took Hong Kong from the British and kind of put it back into kind of its own world, if you will, kind of as a bridge between the East and the West. And so it's going to be very interesting to see for sure. I think that the Chinese are absolutely watching this, you know, very, very closely. And I think that one of the silver linings of this conflict is, well, while sanctions don't appear to be the best deterrent or any of that, they do hurt. Unfortunately for the Russians, I think they hurt their people more than they hurt Putin personally. But, you know, we're doing what we can, I guess, on that front. And it's kind of an area of economic warfare that we're kind of entering in for the first time. And so I think that's a big deterrent for the Chinese to see that, you know, if you get taken off of SWIFT and you get taken off of these areas that are pretty integral to commerce and trade, it can hurt even the big guys, I guess. That said, I think that I don't see why they wouldn't move in when anybody's guess. It could be a year, could be 5 years, could be 20 years, right? But they've made it pretty clear that they view Taiwan as part of China and they want to reunify it. And with the, you know, flyovers that they do with the bombers and the various things like that, the writing appears to be on the wall to me. And so that's honestly one of the reasons why I've kind of been out of China in that area for the most part for the better part of a year at this point. Just because I don't see the US and Chinese tensions really easing at this point. When they do, we're going to see a bunch of companies rocket, you know, like we talked about Alibaba and things like that, who are great on a fundamental basis, great companies, but the big but is they're in China, right? And tough, but a lot of investors don't want to stomach that. You know, doesn't matter what they look like. You know, Charlie Munger is one of the biggest people that is behind Alibaba at the moment and saying, you know, screaming buy, screaming buy, screaming buy. Problem is I just don't know if Charlie Munger specifically is going to live to see that day. I think he's 99 years old at this point. So, well, I hope he's right, but because that would mean a lot of good things for, you know, U.S.-Chinese tensions. But they've made it pretty clear to me what they're looking to do, and it's just a matter of when. And it's going to be very interesting to shield ourselves from this. I think the best thing that we could do is kind of going back to that nationalistic idea of things like what NVIDIA has been doing is one of my names that I'm holding. And a reason that I like them a lot is maybe more expensive, but they're opening up a lot of opportunities in places like Texas and California and other areas like that, so that they're kind of getting away from it. Now, don't get me wrong. If something like that geopolitically were to happen and 70% of the chips get taken out, if you will, right, that type of thing, and NVIDIA is not going to be immune to that by any stretch. But we have time now and everything that we can be doing to kind of preempt that, especially around things like rare earth elements too. And another one back to Ukraine is the neon, actually. So like neon is very critical in the actual foundry or building of the chips. I'm not sure technically why, frankly, but I know it's important. And the Ukraine makes 60% of it. And so that's kind of the tap's been turned off. And we kind of see that in a lot of different areas. Helium is another one that's kind of interesting like that too, where they have a lot of industrial applications that you don't really see, you know, reasons for, like a neon sign. It's like, oh, that can't be important. But when you think about it from, well, you want your iPhone or you want your computer or you want this or you want that, we need neon for the industrial processes, if you will. So those will be kind of other side effects of this that are going to be interesting, that are going to play out, like I said, in a delayed reaction too. We have stores of it and we have this and that. So hopefully the conflict wraps up soon and we can kind of bridge that gap. But let's say they come to a peace agreement in the next week, because I know they're having kind of some serious talks this week and things like that. I can't see us just turning the sanctions off, if you will, right? Like I can't see the next day being like, you know what? Let bygones be bygones, Russia. Don't worry about it, right? Like I kind of feel like those sanctions are kind of here to stay for quite some time, would be my guess. But then again, I don't know. That's just where my head is on it. Is these things are usually quick to come on and slow to come off, just like with gas prices. They're quick to rise, slow to drop, that type of thing.
Yeah, exactly. You took a dive into the semiconductor space, and what I think is interesting too is like throughout this COVID pandemic with all the shutdowns, it seems like the semiconductor space has been hit the hardest as far as like the supply chain issues and everything like that. And with the way that the world is going, everything's becoming smart. Everything's having some sort of screen attached to it, whether it's automobiles or something like that. So we're seeing various industries get drastically affected by this chip shortage that we're going on.
Yeah, like cars specifically, right? Like that's the big one that comes to mind for me.
Exactly. Yeah. So, I think that, exactly like you said, if this China-Taiwan conflict, which seems like it's not a matter of if, it's a matter of when, happens, that this chip shortage is going to, even get hit even harder. So I guess, how are you viewing you kind of mentioned NVIDIA. I know NVIDIA's got the famous Pelosi capital backing as well.
Yeah. Yeah, she's not bad at that. I mean,
Yeah, she's not a bad investor at all.
Yeah, exactly. I don't know if she should be allowed to, but that's a whole nother can of worms. But
Exactly. And so I guess how would you think that we would even get out of this chip shortage area and like start to help? Because I think a lot of politicians are kind of blaming some of this inflation on that aspect of it. When
sure.
When I think in reality, a lot of it is just due to the money printing and some of those other issues.
Yeah,
of course,
I think that has something to do with it, right? Like, for a lot of people that don't know, we printed. I think the statistic is something like 40% of all money that's ever been in existence was created in the last 12 months.
Yeah,
and no wonder things cost more money, right? Like, I mean, if you flood the system, and then it kind of like what we've been talking about all along with these delayed reactions, we're dealing with the hangover of that now, a year and a half later. The market at the time, you pump a bunch of money into it, it's going to go in one direction. It's going up, and that's what it did. And now we're kind of coming back to earth, if you will. And because costs are as high as they've been, and inflation's is kind of a runaway train situation. It's going pretty hard and fast, I guess, at the moment. And the Fed's kind of got their hands tied. I mean, most of the time when we ran into these types of situations, the Fed had interest rates already up. Having zero interest rates is not normal, except for people our age, really, right? Like in our lifetime, they've always been somewhat low, because starting from basically into the .com boom is when it's really started going way down with the rates and things like that. But, in the 80s, they were like 20%, that type of stuff. 70s, even higher than that. And so, I mean, it's a different world that we're in at this point. And I'm not 100% convinced either that raising rates in of itself is going to really change that much with inflation. Mainly because the idea behind that, as I understand it anyway, was to kind of temper down the economy so that you kind of slow that down so that costs come down with it and all these other things. But I'd kind of make the argument that the economy isn't as strong as it may appear on face value, right? Like people point to the jobless claims and those types of things too. But in my opinion, that's really only half the equation, because the other side of it is job openings and quits and all that type of stuff. And we've had the Great Resignation, all kinds of different changes. I'm a pretty good example of it. Honestly, I worked for big corporate for a long time, and I've gone off on my own and have my own business now, for better or for worse, right? But that technology has allowed people to do that type of stuff. And I don't know if the economy is as strong as it may appear. And so therefore, by knocking it down with rates, I don't know if that's going to drive the costs down. It might just push the unemployment rate to match the job openings, for example, or something to that effect, right? It might just be kind of some unintended consequences. So time will tell. And unfortunately, it's really the only hammer we have left at this point. So they're going to do it. That, that the Fed's going to use it. And so that's going to be kind of a tough one for, again, growth stocks and things like that. But again, it doesn't mean that all is lost, if you will, but it's just, I'm prepared, cautiously optimistic, and prepared to just kind of ride it out, and continue to work and make as much money as I can to then put a portion of that in on kind of a strategic allocation basis. And, the hope is 10 years from now, we've sorted this out, even if it took kind of a rough 5 or something like that.
Yeah, I mean, exactly. And you've kind of pointed to it a couple times, throughout this about the Fed raising rates. So I think it was earlier this month for the Fed decided to raise it from, about 0 to 0.25 to about 0.25 to 0.5. They kind of give it to you in a range.
Yeah.
So during that call, they said that they're going to meet 7 more times, I believe, throughout the rest of the year. And they said that they believe they're going to raise rates every single time they meet, and try to get to about 1.9% by the end of the year.
Yeah.
And then the last guest I had, he's at Deer Point Macro on Twitter. So if you're not following him, he's a really good follow, and I think you should.
I will.
But anyway, he went through and he kind of thought that, throughout this, he thinks that, because of the geopolitical environment and, the other stuff going on. And, I kind of ascribe to the theory that, it's a midterm election year. And, that the politicians, their main goal is to get reelected, right? So
Yeah.
if they have a bunch of raising of rates, it's going to essentially negatively affect the market, unless, you subscribe to the theory that a certain amount of rate hikes are accounted for in the market or whatnot. But I think, 7 eventually would kind of bring the market down as a whole. So Deer Point said he thinks that there's going to be about 3. And he says he doesn't think that there's any way that they could do more or less than 3.
I think he's pretty much spot on. I agree with that. So the way I've seen the Fed personally, right, is if you've ever kind of like read through the minutes and things like that, they literally will point out a comma change and things like that, month over month. So what I think, J-Pow's doing basically is going there and looking at it and saying, we need to set expectations and get them to price some of this in now, right? So we're going to tell them the worst case scenario, which is 7 rate hikes at 0.5 each, potentially is kind of as high as he went. But with him saying, a 1.75 ish or whatever it was going to be as their target, right, for the interest rates by the end of the year, they're almost kind of saying that that's probably not going to happen. I do think that they're going to be data dependent, as they say. They really can't telegraph what they're doing very well because the market will react now to whatever that is. So again, I think that they're tempering expectations with the hopes, kind of going into your second point, because politics is absolutely a part of the market. A lot of people, I think, make the mistake of thinking that, frankly, if it was just as easy as the fundamentals and doing a discounted cash flow and things like that, everybody would do this. It would be easy, but it doesn't work that way. and you've got these black swans, whatever you want to call them, that come in and they change the dynamic, right? And so politics is definitely going to play a role into this coming into the fall, for the midterms. And we're going to see, like the Democrats were talking about, cutting taxes, gas taxes and things like that. That's kind of been the exact opposite of what they had been saying for ever, more or less, in the last couple of years and cycles and stuff like that. So, I mean, money will make people change their tune in a bunch of different ways. So I agree with him. I think that the Fed's going overly hawkish so that we prepare for that in the event that they need it. But I think that he's probably right that maybe we see 3 hikes, maybe they're 0.5 each, which would still kind of get us up to 1.75 by the end of the year. But if it's every other month, not every month, or who knows, maybe we see the conflict end, and then that's a good time to move it 0.5 right there, because in their eyes, the market will have gone up. Gravity is kind of what it reminds me of, if you will, and the Fed's kind of bringing us back down to earth at this point. And like I said, we've had for better part of our lifetimes rates at zero, which is not typically how economies function, right? And you can get into all kinds of different things. Like if you haven't, I've looked into MMT, or modern monetary theory, which is kind of at face value, a crazy concept, really, that like you can just print as much as you want as long as people accept it, and that you control that supply, which is what we're doing because we're no longer on the gold standard and things like that. And that's why we printed 40% of the cash. But then you're going to see things rise proportionally. And, kind of back to the inflation topic too, as another small tangent is CPI, I don't think is a great indicator, just like the Fed isn't necessarily either, right? Because they cut out all kinds of stuff and they draw circles around it. And you can kind of make statistics say whatever you want if you're willing to cut out things like gasoline, education, and those are the types of things that are in my life, right? Like, are some of the biggest ones, right? Like, and they'll say it's 8%, but if the CPI is flashing 8%, I'd tell you double that, easy is what I would say as kind of like what the real number is.
Yeah, and I mean, you're exactly right here. So I was just doing some quick math over here to kind of see. So I'm in Tampa, Florida, which has been one of the places that's been growing rapidly and kind of essentially benefiting from the COVID pandemic. So
Absolutely. So is Georgia, which is where I am. So both states, right? It's kind of I mean, obviously you've got DeSantis and things like that, and we've got Governor Kemp, but like we were one of the first to, get rid of the restrictions. You guys were right there with us too. And the influx of people, I mean, my house cost has gone up significantly in the past 2 years because of this, because my theory is honestly, I've got clients in all over the country and stuff like that. If you're coming from a New Jersey, a California, a place like that to an Atlanta or a Tampa, the cost of living from your eyes is so much less than it is to us who kind of grew up in it. I grew up in Atlanta. And they're dragging the housing prices and things like that with it, because to them, I had a boss actually before I went off on my own, and he worked at Microsoft. So he came from Seattle, and he was like, you can get a lot of a house for $1 million. I was like, yeah, you're damn right. You can get a lot of house here for $1 million. He was like, I mean, I had nothing back home, and I have he was like, I'm getting a pool, I'm getting this. And I was like, good for you, man. Like, that's awesome. But to him, he was like, this is incredible. I can have land, like I can have multiple stories and stuff like that. And I was like, making me think, I was like, geez, like, God, that's gotta suck to where, $1 million doesn't even get you 2 stories in Seattle.
Yeah.
That's a ranch on a quarter acre kind of thing.
Exactly. Yeah. So, I mean, you could definitely relate. And, I closed on my house at the end of September 2020, and I just did the math. Like, according to the Zillow estimate, take for that what you will.
Yeah.
But my housing price has gone up 48% since that time.
Which is
and
crazy.
so and so obviously, the year over year inflation of 7.5% just isn't even close to accurate.
No, that's not what it is. Not for the. So there's one metric that I actually really like. It's back to McDonald's. It's the Big Mac indicator, and that's in 41%.
Wow.
Yeah. That. And so that is, I think, the best indicator for inflation as a proxy, because what it does is it takes into account the globe. McDonald's is everywhere. Tons of input costs, right? And frankly, a Big Mac is like the last thing that the price raises on ever.
Yeah.
And the fact that it's on 41% in the last year, that's where my money is when it comes to inflation, not 7-8%, right? Like, I mean, look at cost of schools and things like that. What's insane is like talking to my dad about, like, he went to college in, 1979 to 83 or something like that, right? It was like $1,500 a semester. a lot of people pay $100,000 a year now to go to school. And, but that's not in CPI, right? Like you're like, wait a minute. So how could that be excluded? How could cost of living be excluded? How could gas? How could this? How could that? It's a basket of goods. And it's kind of literally like as if they had gone through a supermarket and grabbed a bunch of stuff and thrown it in there. And then, oh, it's only 8% more. So, just like kind of we were saying with the Fed, like you kind of have to be able to start reading between the lines a little bit. And that's what really kind of separates the good investors from, the ones that are kind of taking it at face value, because what they teach you in the book, if you will, I wish was exactly the way it was. But if it was, everybody would just do it, right? We wouldn't have these conversations. It would just go in a straight line up. It'd be nice, I'm sure. But the market's built up of people, and people are kind of irrational, which is why the market's irrational.
Yeah, exactly. And I was actually just looking at, I discussed this on another podcast with at Joey Tweets, who's the host of the Canadian Bitcoiners podcast, because, a lot of Bitcoiners as in general look at, Bitcoin essentially was looked at as almost as an inflation hedge at one point.
Yeah, no, it certainly was.
And now I think
that didn't pan out.
Yeah. So now I think it's kind of looking more as like, a global reserve currency as maybe even tied to the dollar. There's been some books written instead of the gold standard, it'd be the Bitcoin standard and things like that. But just looking at the breakdown of the CPI numbers from last month, here, I'll read out a couple percentages for you.
Yeah, let's hear it.
Yeah. So energy services, including fuel or oil, it was up 43%. Gasoline, all types, up 38%. Energy commodities, up 37.9%. New vehicles, up 12%. Used vehicles, up 41.2%. So, I mean, obviously, just from some
CPIs
of these,
at 8.
Yep, CPIs at 8. Food away or food at home, which I don't even know how you can account for that, but food at home is 8.6%. So it's even higher than the 7.9% reported. So
obviously, put the big back indicator on there, because 41% sounds pretty good right now, right?
Yeah, exactly. And so I agree with you 100%. It's like they're reporting one number and they're trying to get to the lowest possible number when inflation is that bad. So the average person, the average Joe in America, understands that inflation is a lot higher than that 7.9%.
For sure.
So I guess you kind of talked about the the monetary theory there. Let's get into it. So what do you think, like, I guess, is the solution
of MMT?
Yeah. Do you think,
you down with MMT?
Well, I mean, I like I told
you know me is what you got to say.
Yeah, exactly. That's good. But yeah, I mean, like I told you before, I'm kind of a Bitcoin guy, so I kind of ascribe to that theory where maybe taking it out of human control would kind of be a little bit better for the consumer and people as a whole. But what do you kind of see as the solution to get out of this in extremely inflationary time? Do you think that there's an end in sight? I know we've had Yellen come out and say that expect to see high inflation for at least another year or so, which obviously probably double that amount of time at least. So how do we get out of this?
So I mean, it's the $1 trillion question at this point. Really, we've inflated it to where you can't even use that that moniker anymore, really. But I guess I think we really need to solve the labor problem first, honestly. So, like, I think that people are looking at the wrong metrics when it comes to employment, right? So the jobless claims, things like that, versus the job openings. And, the Great Resignation appears to be pretty real. People working from home and kind of changing that up. I think the pandemic was a big kind of eye-opening moment for a lot of people in terms of, is this what I want? Is this what I really want to do? Whatever. And we saw kind of people make changes left and right that kind of disrupted the market and things like that. But what worries me a bit is stuff like, I don't know, autonomous vehicles is a good example of it, right? And a lot of companies, for profit margins, X, Y, and Z, would love to see the day with no drivers. But what worries me is well, what are those people going to do? And what's the answer going to be for that, right? Because if we've got an inflated environment already, and then we start taking away the ability for folks to make money, that could kind of spell trouble, in my opinion, right? So I think that we need to figure out a way to incentivize companies to not take advantage of automation, right? I'm in technology, for God's sake, right? So like, I mean, I build systems for a living, but the way I look at it is I try and build like a work platform that allows people to continue to do their job, but at a better, more productive pace, right? And then I think that we need to start addressing a couple of the kind of the big ticket items. Like I think that a lot of folks have got them picked out pretty well in like education costs, for example. I think the problem with education costs is the loans in the schools, not just the basically we've set up a game for education where you can charge anything you want because you're expected to just go get that interest-free loan or whatever, right? From whoever. The government will give you this. The government will give you that. And what is that? Or not the government, a private company, whoever is going to give it to you, right? But we've looked at prices go from what my dad paid in the 80s of $1,500 to 150 grand for if you're a year if you want to be a doctor at a lot of places like that, right? And I think that college may not be the answer for everybody. I think that a lot of people would be better off going to trade schools and doing different things because we're seeing basically kind of a split between skilled and unskilled labor. So like things like plumbers, trash folks, electricians, general contractors, things like that are in super high demand, and you can make a really good living these days off of salaries like that you don't really need college for. But we kind of live in a society where you're looked down upon if you don't do it. You're expected to get the loan. The school looks at it as well, it doesn't matter what I charge you because somebody's going to give you the money. But what they all forget is that somebody's got to pay the piper at the end of the day, right? And now we're talking about stuff like canceling the debts and things like that. And I don't think those are the good answers either, because it's like, well, so I'm the guy that paid out of my pocket, or I paid for my kids to go to school, blah, blah, blah. Kind of what about them, right? And you get into all the whataboutisms and stuff like that. But to answer your question again, I think that we need to address the labor problem first and find a way for people to be able to make good fundamental family decisions on what they're going to do with their life and things like that, and incentivize them to go in those directions with or without a big bill attached to it for school, right? Like if you're going to go, I don't understand why an art major exists, truthfully. Like, I mean, I've got art behind me. I love art. It's not that, but Picasso didn't go to the art school, right? Like, like all these people kind of figured that stuff out on their own. And so I think that we should kind of push people in those types of directions. I think that we need to teach economics and personal finance as a math. Like, people in education and things like that, that model was built to basically pump out a bunch of good factory workers. That's why you learn geometry, trigonometry, all that type of stuff, so that you could do the angles, you could figure all that type of stuff out. We live in a different world these days. Like, I think that if you taught somebody how to, frankly, balance a checkbook and invest, you'd be in a whole lot better shape today than learning geometry, right? And people balk at that idea, but to me, they're both math, right? You're learning numbers, you're learning how they work. You can get very complicated with it too, but I don't understand why we don't teach kids basic financial information and things like that as well. So I think education, labor, and honestly, I think a lot of deregulation is needed to basically make it easier to live the American dream, if you will. Because I mean, that's what I'm trying to do now. I left like big corporate. I've got my own company. I've been doing it for a few years. I've made it through COVID at this point and stuff like that too. So, knock on wood, if I was going to fail, I felt like I'd fail by now. And I love it. But at the same time, why can't other people do this easier, or why do they need to make it so seemingly it feels very difficult to do this type of thing? Like, I feel like I'm working harder now than I did at any of my other jobs and things like that. It's more rewarding, but there's a lot of extra things that you have to kind of figure out on your own. And to me, that's taken a lot of dedication and work. And frankly, I'm still figuring a lot of it out, right? Like, it's kind of a never ending game.
Yeah, and I think it kind of goes back to the issues that we have in the education system. It kind of reminds me of like Kanye West. So some of his early albums, he tells you that people graduate and they're still stupid because everybody tells you to
Yeah.
read this, eat this, do all this kind of stuff. So,
Right.
and that theory definitely still holds true. So yeah, I think we're kind of we're kind of shifting backwards, and people are trying to get a little bit more automated with things when I
Mm-hmm.
think it's making the trades more desirable. Well, let me get you one last question to wrap it up here.
All right.
How are you feeling going into the rest of the year? I know you said you're a long-term guy, so
Mm-hmm.
all the macro stuff going on. How are you feeling with the next year to a couple years? Are you bullish, bearish on the stock market? How do you think we're going to go? You think we got a bumpy ride ahead, straight up, straight down? What do you think?
I think it's going to be bumpy, but the good news is I love being a bull and I want to be a bull. So I do look through things through rose-colored glasses at times and things like that. It's just my nature. And things have kind of been beaten down for such a long time as well that sentiment is way, way, way down. So if you kind of believe in mean reversion and things like that, and I think that sentiment is the number one indicator is if the market is going to go up or down, right? And since we're so in the dumps, if you will, on a sentiment scale, I think that we might see kind of a drift back up into the summer and into some of these months and things like that. I think that as that happens, the Fed's going to kind of kneecap us a little bit each time because their prerogative is to taper down, reduce inflation and all those other things. So there's going to be some things in our way. So we've got hurdles, but I'm staying the course. I'm going to be long. I think in 5 years, the stock market is going to be higher than it is today, from that perspective. Shorter than that, it's going to be all over the place. I mean, we'll probably see 10% correction again this year, 20% up or something like that, like we did, last year. Let's see how it pans out. But I think that stick to your strategy. And if you don't have one, develop one. And if you don't have that, just stick to the averages. They'll protect you in that respect. Because even if, like I said, it's not truly diversifying, there's 5 companies that'll hold you up. Just let them do it. But overall, I'm bullish.
There we go. Yeah, there we go. All right. Well, that's the end of the show. Strib, tell us where everybody can find you. I know we mentioned a little bit of the.
Yeah. Find me at Strib on Common Stock or Sam_Stribling3 at Twitter. Far more active on Common Stock, so I think there would probably be the best. But feel free to reach out with any questions or anything like that. DM me, whatever you need to do. Always happy to talk. And honestly, Brandon, thank you so much for having me. This was an absolute pleasure.
All right. Thank you so much for having us. All right. That's it. We're wrapping it up.